Hey everybody, this is Tim, and I just wanted to go over some things here. This was another Fed day. The Fed made their announcements today as far as what they're going to do. But they've been having a meeting the last few days and came to the decision today to keep rates steady. That's kind of what everybody was thinking. However, everybody was thinking that's what they would do, not necessarily that's the best thing. But they did have two dissenters today, two people who wanted to do a rate cut. Normally, after they've had all their discussions, they will come to some sort of an agreement that everybody will vote the same way. But today you had two people vote differently, which has not happened in 30 years. So that tells us that they've got some people who are on the fence and who really want to start cutting rates now. But anyway, they did not, so they kept the rates the same. I think that because there were two dissenters, I think it's extremely, I would say, much more likely that they will make a rate cut in the next meeting, which is September. And I think that total for the year, when you look at some of the sites and what they're saying, total for the year is probably going to be three rate cuts by the end of the year this year. So that's kind of what we're looking at, I think. I just wanted to get into a little bit of the details about what they're doing and what they're saying. Powell keeps saying that their goal is the 2% inflation goal, and that's why they're keeping rates high, is because they're running above the goal because we're like 2.5% or something like that. And so he keeps talking about that sort of thing, but it's unbelievable to me because these people are supposed to be so smart, and the way they're approaching this is so unbelievably stupid because there's no way it's not possible for them to hit that 2% goal unless they cut rates, because there's something called the inflation paradox, and that's what we're in the middle of right now. The inflation paradox is that like 30, I think it's like 34 or 36% of the inflation number is made up of what's going on in the housing market. And so what's happening is the interest rates have been remaining so high in the housing market that there are a lot less houses on the market, and as a result the prices keep going up and the buyers can't afford them. So that causes the prices to go up, less buyers on the market as well, so there's less demand for the houses, and causing the prices to go up. And 34% of the inflation number is made up of the housing prices and what's also considered as owner equivalent rent. So as the housing prices go up, the rents also go up, and 34% of the inflation number is made up of those numbers. So those rental numbers are staying up in the 5 to 6% range, where the housing numbers in that 5 to 6% range, and that's bringing the entire inflation number up. If they would lower the interest rate, then you would have more houses on the market, and you'd also have more buyers on the market, and you would see those numbers come down. What would happen really is that a lot of the people who purchased a home the last 5 years, they got a really good interest rate, 3%, 3.5%, something like that, and they're not wanting to sell their house and go buy something else when they're going to get 6% interest rate or 6.5%, right? And so, if the interest rates on the houses were to come down into the fours, then you would see some of these people in the threes be like, well, the fours isn't really that bad. So they would decide that they're going to put their house on the market, and those numbers would start to come down as a result. And the shelter component, like I said, it makes up 34%. So I'm going to go ahead and share a screen real quickly, get into this a little bit more detail. And so you should be able to see this here, the inflation paradox. So the Federal Reserve raises interest rates to slow inflation, but in today's market, those high rates are actually helping keep inflation high because of housing. And this is because the shelter component of the PCI, which is an index that they use, 34% of the consumer price index is shelter component. So as the shelter stays high, rent and owner equivalent rent, as you see here, and the owner equivalent rent, that's the other thing. Owner equivalent rent lags by 6 to 12 months. So even once you start lowering rates, it's going to take this number a while to catch up. They should have been lowering rates already several months ago because of this lag, but they haven't been. And they're never going to get to that 2%, no matter what they do, without bringing rates down so that the shelter component improves. So that's the problem we have right now. Reduced housing supply, millions of homeowners are locked in at 2 to 4% mortgage rates. They're not selling, so resale inventory is historically low. Low supply plus stable demand equals home prices remain strong. Renters facing rising costs. Owner equivalent rent rises accordingly. And shelter is a lagging component. So even in real time, rent data shows softening. Owner equivalent rent is still rising because of that lag. And so that's what we have right there. And that owner equivalent rent, that number stays within that PCI number. So even though real-time data is showing that the rent numbers are coming down, and we've seen that the last couple of months, the owner equivalent rent is still rising because it's based on a lag of 6 to 12 months. So anyway, it's a vicious cycle as they show here. Fed hikes rates to fight inflation. Housing supply drops, fewer people sell their homes, prices and rents rise. Inventory crisis keeps pressure on costs. Shelter inflation increases. Owner equivalent rent feeds inflation indexes. CPI and PCE stay elevated. And so Fed delays rate cuts because this number isn't coming down, even though if they made the rate cuts, this number would come down. So it's bizarre to me that these people in the Fed aren't smart enough to realize that they're the ones that are causing the inflation numbers to stay elevated. But anyway, that's what I wanted to get into really quickly. But I do believe that they will probably make 3 rate cuts by the end of the year, simply because we did have at least a couple of dissenting members. And like I said, we haven't had that in 30 years. So you've got people in the Fed who are, quite frankly, fed up. And so they want to make rate cuts. And one of those people that dissented is someone who, it's governor, one of the Fed governors, Governor Waller, is one of the probably top 2 or 3 people who are being considered as a replacement for Powell. Now, that doesn't happen for I think it's another close to a year, probably a little bit less than a year. I think it's next summer sometime when Powell's term will be up. And there's no way that his term will be renewed. He did get renewed by Biden. He was first put in by Trump. He was renewed by Biden. And there's no way Trump renews him again because they are really at odds at this point. So, but anyway, Governor Waller is somebody who already has believed we should be making rate cuts, and he is one of the top people up to replace Powell. And so I think he's going to keep pushing the envelope on this over the next couple of months to try to get a rate cut for September. And I think that's very likely that we get that rate cut for September. So anyway, that's kind of what we're looking at now. If they are expecting a rate cut in September, that would at least help the markets a little bit now. You would see rates come down a little bit. But the other thing they did mention in this meeting is that they are continuing the balance sheet runoff. And that also hurts us a little bit because if they are reducing their balance sheet, that will cause the rates to rise a little bit. So that's something that's going to be fighting against us a little bit there. So it's just hard. It's hard to really tell what's going to happen if they keep doing that as well. That's called quantitative tightening, and as long as they are tightening, that's bad for rates, for long-term mortgage rates. So anyway, that's pretty much it. I hope that this has been enlightening and you got something out of it. But that's kind of what we're expecting at this point, is possibly 3 rate cuts by the end of the year. Thanks.